Welcome to TradeTheNBI.com. This is John. This report is for the 13th, and well, here you have it. It's pretty clear and simple, straight up. More tax reform looks like it got the final approval. You can see that our shakeout has made new highs, corresponding to new highs, so that's a good thing. And DOC with the cyan under red, always bullish, and even with the steel continuing to move forward, still climbing higher. So those are all good things. Getting a little overbought, and you can see that we've got retraces set up built into this move, but this is going to change until we get an actual turnaround in any of those readings that suggest that we might see some kind of fading. But we're just in a nice, slow, methodic, and this is exactly what we talked about, many months ago, the early part of the year, about this being like the early 90s, where you have a change in, solid growth potential. You already got the EU complaining about the U.S. growth policy, and tax reform is pissing them off, and there's all sorts of, crying and moaning, because the reality is they see a huge change in what's going to happen for the U.S. when they know the U.S. economy gets going at a juggernaut speed. It's going to be unstoppable, and it's both a good thing from a growth standpoint, but it's also going to mean higher interest rates, which means capital flows to the U.S. from everywhere else. And that's what they're really concerned about, because they have fragile economies that are basically stagnant and not improving, and that's only going to create more pressure for them. But NQ still lagging behind and creating a little bit of a resistance to kind of any kind of blowout move at this particular point. Decent from an extreme histogram standpoint, so it's not overbought from the NQ standpoint, where the S&P is just a little ahead of itself, and not too shocking. The reality is the euro has to fade back into this, because the pressure for mounting U.S. rate increases clearly has to be growing, and so that's going to put some pressure on this, because it's artificially elevated anyway. It should be back well underneath this 115 range. So the fact that they've been holding it up has been an added bonus, because it really puts pressure on the EU from an export standpoint. Makes it a little bit more difficult when it's elevated the way it has been. And that's okay. And gets back, it's funny, because we're starting to see articles about how cryptocurrencies could be impacting the gold trade. How long have we been talking about that since we've seen that divergence beginning? I think saw a couple of articles on Zero Hedge about it just now. It's like, okay, you finally are waking up to the fact that gold was always a hedge, and if you've got to have a hedge that's moving around, you might as well go to the one that's got the most volatility. Though I did see that also it has increased the point with Bitcoin to where it has exceeded the tulip phenomenon, which goes back to the 1600s. So now we have the greatest bubble ever associated with cryptocurrency, and it doesn't look to be the end of it by any stretch. It's just begun. Bonds still elevated compared to what they should be, and here we go with oil. It's just maintaining something actually quite decent value there. I mean, certainly enough for suppliers to be doing okay with that, and if it maintains that, it's not a huge inflationary pressure, so that's a good one. You can see there's the gold fall off, holding on, but that's a horrible shakeout in these readings. It's getting to an extreme oversold here, where we're likely to see a bounce. When we get to this minus 83 on this, usually you start to get a turnaround move, just because it's sort of like the easiest way to refer to it would be a dead cat bounce. I think that would be the cleanest. So here's what we've talked about. I'm going to shrink this again to show what we were talking about from our original buy signal way back here, the 30 range, and then I said just leave it at the 50% Fibonacci and just let it continue to roll, and all the way from the 2630 something range here all the way to the 2668. We knew it was going to start to fade back a little bit, and I suggested just picking the start of the day here, just leaving it at a number that was a little bit more comfortable, because as we got into consolidation, this was going to rise faster than you knew you were going to get an automatic retrace to a point where the range became too narrow. You were just going to get stopped out if you kept raising it at that level. There's nothing wrong with doing that, because you can always re-enter. It's not a bad way to stop out of it so you're not leaving too big a point spread, but even leaving an 8 or so point spread from where it begins and allowing it to just trail naturally from there is not a bad thing to go as well. So you can see we had a little bit of a shakeout dip there, but nice clean reset. Didn't get the steel reset, so it's going to flatten out for a little bit longer still. So we'll get a little bit of fill back in here. It's not going to hurt anything, but it's been a run just as we expected and beautiful for the holiday trade so far. So I think that we've been spot on with it. No reason to get crazy with it, but certainly setting up a point now where you've got a stop out point that will then allow for re-entry. It also allows you to collect and lock in returns, so that's always a bonus as well. I've never objected to that. There's nothing wrong with having a trade run a nice run. It's been a beautiful run for the last few days and a significant point gainer, so no objections whatsoever. And nothing to really put up because it's just straightforward stuff here. It's clean and simple. So with that, let's let it go. We're getting close to my birthday on Thursday, which was so much fun. Glad to finally be feeling better. So that helps. Dramatic change from being flu that's supposed to be horrible when it gets to the U.S. It's been pretty bad here in Europe. So, anyway, as always, though, trade well. We'll talk again later.